short answer is jobs. When the Fed started forecasting that they wanted to lower interest rates months ago, the market had already priced in lower interest rates by 1%. So in the September Fed meeting, they announced a 0.5% decrease in the rate. However, markets had already come down 1%. So if markets started coming down 1% and the Fed comes down 0.5%, then the markets weren't really pleasantly surprised. They were like, meh, and they shrugged it off. Then a couple weeks later, the September jobs report came out, and this is the crucial trigger which caused rates to jump in the last couple weeks, back up by 0.5%. As you'll see here from CoStar, the preeminent listing service for most commercial real estate, they have their own research teams, and they show here a graph of the September job gains. They had finally bounced back up in September after quite some time of declining. This red line is the 3-month moving average. You'll see it's steadily declining. And here you'll see that according to the report, employers added 254,000 jobs in September, which was far surpassing the expectations. And the revisions to the July and August numbers added 72,000 more jobs. So the long story short is that we have way more new jobs than anticipated. And when that happens, that's good news for the economy. And furthermore, the unemployment rate decreased from 4.2 to 4.1%. So basically we have more jobs than expected, less people unemployed, which means that the economy is stronger than expected. And when the economy is stronger than expected, then the market expects the Fed to not decrease rates again. So the market now bounces, or the rates bounce back up by 0.5% to where they expect it to lie for a while, because the Fed will be less accommodative since the economy is so strong. Now, how does that affect us in real estate, or any of you in real estate if you're thinking of buying or selling a home? Let's take a look. Well, recently, I'm looking at September data. We're in October now, so we're looking at what just happened in the last month. You will see that the price per square foot, the median price per square foot, has begun to decline in the second half of the year, which is common, cyclically common. You'll see here from May until now, it's come down a little bit, just 3%, not a lot. And last year, same thing happened, August to the end of the year. The year before that, same thing happened, May to the end of the year. The year before that, it was flat. And the previous 2 years, 19 and 20, were not. But if you look at the longer term trend, over the last 15 years, you'll see this regular curvature in the line. So you'll see what I mean by a regular cyclical effect. Now, that is the price per square foot, and the days on market have begun to climb. Also a typical cyclical seasonal effect. As you'll see here, days on market typically climb into the end of the year, into January every year before they begin to decline, meaning it takes longer for properties to sell towards the end of the year. But then in the beginning of the year, they start selling faster again, so the days on market begin to decline when things sell faster. Months of supply, again, we're climbing a little bit here, and I'll show you a zoomed in version. Boom, climbing a little bit here. And that's the price per square foot, and the percent of original price is flat. That means on average, or I guess the median, seller is getting pretty much what they're asking for these days. And I think what also helps is that sellers are being more reasonable with their ask. They're not asking for the moon anymore because they know that the market is more balanced these days. So as a buyer, one thing you'll want to look out for is that interest rates have jumped 0.5%. That obviously affects your payment. Whether or not to be worried is, nobody can predict the future, but the reason rates have increased by 0.5% is because the economy is stronger than expected. So I would say that's a pretty good thing if the economy is stronger than expected. So if you buy a house and your payment is a little bit higher than you had expected, you might rest assured that the economy is also stronger than expected. So hopefully there's more buyers behind you in the future that are qualified and ready to buy your home one day in the future when you decide to turn around and sell it. Now, as a seller, I would say, well, the economy is stronger than expected. However, you have to keep in mind that the buyers now have a higher payment than they did just 2 weeks ago. So it probably will affect their desire to pay you full price or higher. So expect a little bit of softness, especially given the seasonality, given that it's in the end of the year now and the holidays are quickly approaching. So now we're in October. I think it's still a great time to sell before Thanksgiving and Christmas. If you can, call us right away. And if you can't and you need some time, call us so that we can help you prepare and be ready for the beginning of the year, or at least navigate this end of the year, because it's not impossible to sell a property. Properties are still sold. In fact, I'm going to show you here that active listings, pending sales, closed sales. Every year, towards the end of the year, it might be the lowest number of closed sales, but there's still 10,000 sales, right? Properties are still selling. It's not that they don't sell. It's just that there's less sales, less number of sales than in the peak spring season. So call us if you have any questions about what it might look like to buy a property in today's market, or what it might look like to sell a property in today's market. And if you have any other questions about the economy or anything else, we're happy to answer. We're open book. God bless you. My name is Marcus Ibrahim with Team Ibrahim, and please feel free to connect with us on social media.